Have you ever wondered how you're going to be taxed after you sell a piece of property, a land or a house or commercial property? Well, today we're going to dive into the different categories you may fall into if you decide to sell your property. So in a separate video, we covered the whole sales tax portion about selling a property, whether you will be taxable or not. And in this category here, we're looking at it from an income tax perspective. So there's a big difference between sales taxes, which is what the buyer pays, and the income tax perspective, which is how much income tax you owe on gains that you've made on this piece of property. What you want to look at here is whether this sale will be treated as capital gains or whether this sale will be treated as business income. And you might wonder, well, what's the difference? Why am I interested in knowing this? Well, if it's treated as business income, the whole amount of your gain is taxable. So let's say you buy something for $200,000 and you sell it a few years later for $300,000. That whole $100,000 worth of gain is subject to income taxes. And let's say you have a really high income tax rate, maybe 50%, you might owe 50% of that gain to the government. Whereas if it's treated as a capital gain, only 50% of the gain is taxable. So the same example, you buy something 200, you sell it for 300, you gain 100,000, but only 50% of that goes on to your income taxes. So as a gain of 50,000. So again, if you have 50% tax rate, well, now you'd only owe 25,000 in income taxes. So there's a big distinction between the two. There's certain advantages to both of them, and these will be treated extensively in two separate videos. But what makes a sale treated as business income versus capital gains? Well, the big question here is, what was the intent? Naturally, like for the sales tax, if you're a business operating, well, naturally, you're going to be business income. If you're just an individual who bought a house and 10 years down the line, you sell it, it's seen as personal, it's going to be seen as a capital gain. But once again, there's this gray area between the two. And that gray area comes when you have an interest into flipping houses. You often hear people say, well, I bought this house, I renovated it a bit, and I sold it a year later, and then I did the same thing over and over and over again. Or builder friends who build a house, live in it for a year, and then sell it to a profit and just keep on repeating it. There's no set rule into how many times you can do this and still be treated as capital gains and not be treated as business. But the whole idea here from the income tax perspective is, what was the intent? So if the government can prove that your intent from this purchase in this sale was to make a quick profit, well, even though you may have kept the house for a whole year or even a year and a half, if your intent was clear that it was profit, you should be treated as business and business income. There's a lot more documentation and questions revolving around this, so I suggest you guys to take a look at the links that I've included in the description. And in the two separate videos that you should be looking into the future is business income. If you're treated this way, how could you minimize the income tax owed? And we'll see that you'll be able to declare expenses, and we'll get to that. And if you're looking at from a capital gains perspective, well, how does the principal residence tax exemption work? And we're going to look into that and look at all the nitty-gritty details about tax exemption when it comes to principal residence. So I suggest you guys to look at those videos. Hope you enjoyed this one. I'll see you soon. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real-life examples. Have a good day.